CNBC, the channel that spent nearly a decade mocking cryptocurrencies, calling crypto a tulip bubble, a playground for dreamers, a scam for people who don't understand finance. Suddenly overnight turned around and called XRP, the trade of the year, a complete reversal. And the story didn't stop there. Then, BlackRock, the largest asset manager on the planet, began lining up to file applications to launch an ETF for XRP. And there was even news that President Trump announced plans for a national digital currency reserve fund. Everything happened in rapid succession, dense and fast, so fast that it makes you feel as if the entire financial world suddenly awakened to crypto overnight. And at this moment, the most important question that needs to be asked is this really just randomness, a series of lucky coincidences? Or is it a chess game that has been carefully calculated for 10, even 15 years? That is exactly what we are going to dissect together today. The strategy of major financial institutions. How they turn something that they themselves once called a scam into a perfectly packaged financial product to sell back to the public. And most importantly, how we retail investors can distinguish between promises of decentralization and the reality of institutional capture. Because if you don't understand this, it's very likely that you will be the one who arrives last in the game. And if you don't want to be the person who walks into the room last buying back the dream at the highest price, then subscribe to the channel. To understand this entire play, there is an extremely apt metaphor. Imagine a luxurious club outside. There is a long line of people eagerly waiting to get in. At the door stands a tall bouncer with a stone-cold face, shaking his head and saying, "Sorry, the club is full." Instantly, a sense of exclusivity is triggered, scarcity is created, and people desire to get in more than ever. But if you look inside, the truth is completely different. The owner is pacing back and forth, anxiously calling promoters, almost begging, "Please bring more people. This place is too empty." The business license is at risk. Revenues are below expectations, and the only thing keeping this place looking valuable is the bouncer's shake of the head at the door. That refusal is not reality. It is marketing. Because when the last person is finally allowed to enter, they are so delighted that they are willing to pay an exorbitant price for a mediocre cocktail without realizing that they are standing in a nearly empty room. And this is exactly the script that Wall Street has applied to digital assets. A paradoxical script built very early and executed with extreme patience. Now let's rewind time a little back to January 3rd, 2009, the day Bitcoin was born. Right in the very first block of data, that Genesis block Satoshi Nakamoto left behind a message. Not code or a password, but a line quoted directly from the headline of The Times Chancellor on brink of second bailout for banks. That was not a coincidence. Bitcoin, from its very first moment, was not just a technological invention, but a political statement, a direct reaction to the 2008 financial crisis, an act of resistance when banks caused a catastrophe and were bailed out with taxpayers' money, while the savings accounts of those very people received only 0.1% interest. Bitcoin was born from that injustice, with an extremely clear original promise: only 21 million Bitcoin, no central bank. No one with the power to print more designed to become digital gold, a monetary system that requires permission from no one. And of course, Wall Street hated that, not mildly, but with deep, bitter, and very public hatred. In 2017, Jamie Dimon, CEO of JP Morgan, went on television calling Bitcoin a fraud. Warren Buffett likened it to rat poison squared. And Larry Fink, CEO of BlackRock, bluntly declared that Bitcoin was merely an index of money laundering activity. Harsh, noisy criticism that lasted for years. But these are not ignorant people. They are the sharpest financial minds on the planet, and precisely because of that, the real question is, did they not understand Bitcoin, or did they understand it all too well? This was not conservatism, but a strategy of narrative control. You cannot charge tolls on a road if you haven't built the toll booths yet. And by publicly criticizing Bitcoin, Wall Street prevented retail capital from flowing into an asset they did not yet control at a time when there was no institutional custody infrastructure, no regulated investment products, and most importantly, no way to collect fees. So, when they were not ready, that asset had to be labeled a scam, too risky, not for serious investors. The most ironic part is that while their CEOs were on TV, calling Bitcoin a fraud behind office doors, their lawyers were quietly filing patents for the very same technology. This was not a misunderstanding, but corporate-level hypocrisy. Jamie Dimon criticized Bitcoin publicly, while JP Morgan filed hundreds of blockchain patents. Fidelity quietly began building institutional crypto custody services. In 2018, Goldman Sachs started settling Bitcoin futures contracts. And BlackRock, the fiercest critic of all, held private meetings with Coinbase to build infrastructure. They were the nightclub owners, in the earlier metaphor, their mouths saying, "Sorry, we're full," while their hands were building more entrances, opening more bars, installing billing systems, and erecting rows of toll booths, exchanges, custody, ETFs, tax reporting. And then when everything was ready, the green light was switched on. In January 2024, the SEC approved a wave of spot Bitcoin, ETFs. The nightclub doors officially swung wide open. BlackRock's iShares, Bitcoin Trust IBIT, pulled in $35 billion in just 10 months, becoming the fastest-growing ETF in history. And from that moment on, the tone changed completely. And then a very interesting moment happened. Jamie Dimon no longer called Bitcoin a fraud. Instead, he began saying that Bitcoin has real-world use cases. And Larry Fink. The man who once called Bitcoin an index of money laundering now praises it as a global asset, a form of digital gold. So what is the question? What actually changed Bitcoin's source code is exactly the same. The supply is still 21 million, no more, no less. There was no update that made it more friendly to Wall Street at all. So, in the end, what happened? The answer is very simple, but also very cold. Wall Street gained control of the gate. They couldn't change Bitcoin, but they didn't need to. Instead, they built a financial wrapper around it like this. You want easy access to Bitcoin, safe, legal. No wallet, no need to remember private keys, no worries at all. Just buy our ETF 0.25% management fee per year. And that's it. A tool created to escape the financial system became the best-selling product inside that very system. In finance, they call this process financialization of an asset. It sounds complicated, but put bluntly, it's this: they created a financialization trap. People think they are investing in Bitcoin, but in reality, they are just betting on Bitcoin's price volatility. All the risk, up or down, belongs to the investor. And what about the intermediaries? They sit in the middle, collecting steady fees, whether the market goes up or collapses. This is the essence of the trap risk, is separated from the profit of the product seller. And the consequences are even larger than that. Bitcoin from an asset expected to be uncorrelated, a refuge from the traditional financial system, began to behave exactly like the stock market. After the ETFs were approved, the correlation between Bitcoin and the S&P 500 surged to 0.72. This number is extremely important because 0.72 means that when stocks rise, Bitcoin usually rises with them, and when stocks crash, Bitcoin crashes too. The original promise of an independent asset, a portfolio hedge, has almost disappeared, replaced by Bitcoin behaving like a high-leverage technology stock. And to clearly see how this trap operates, look at a very ordinary story. Let's call him Alex. David is 45 years old, lives in Ohio, and has about $85,000 in his retirement fund. He's heard about Bitcoin for years, but he's hesitant, afraid of wallets, afraid of private keys, afraid of making a mistake and losing all his money. Then one day, he sees BlackRock's Bitcoin ETF appear right inside his familiar Fidelity account, just a few clicks, so convenient, and Alex decides to put $10,000 into it. But what really happens behind that convenience? BlackRock collects a 0.25% annual management fee. Fidelity may collect additional transaction fees, and if Bitcoin rises strongly over the next 15 years, then Alex makes money, great. But if Bitcoin goes sideways or drops sharply, That's fine too, because BlackRock and Fidelity still earn money steadily. They don't bear price risk Alex does. Alex thinks he is buying Bitcoin, but in reality, he is paying institutions to monetize his attention and expectations. And when you multiply that model by the $35 billion of assets that the iBit Fund is managing, you get about $87.5 million in revenue every year. Whether Bitcoin goes to $1 million or crashes to zero, an almost perfect money printing machine. And when this scenario succeeds brilliantly with Bitcoin, they realize one very important thing. If it can be done with Bitcoin, it can be done with any other asset. Bitcoin has been tamed, packaged, put into a glass box, and is ready to be sold to people like Alex. So, what is the question being asked right now? Is this already the final stop, or is everything we've just discussed only the warm-up? The answer is that this is only the first step. Bitcoin was never the destination. Bitcoin is a test, a psychological test, a proof of concept. It proved one extremely important thing to Wall Street. The public is willing to buy digital assets as long as they are sold through familiar channels and packaged as safe enough. Bitcoin ETFs are not the final victory. They are merely the answer to the question, does this model work? And once the answer is yes, the next step becomes very clear. To truly control the game, they need something more malleable than Bitcoin, something that was not born to oppose them, and that is when XRP steps onto the stage. Why XRP when there are thousands of other cryptocurrencies? Because from a bank's perspective, XRP is the perfect choice. Bitcoin was created to challenge the banking system. XRP was not. XRP was designed to serve that system. It focuses on cross-border payments, faster, cheaper, more efficient, the things banks actually care about. But more importantly, XRP has a central entity, a company, an address, a place that regulators can call a counterparty to sit down and negotiate with. And that is something Bitcoin will never have. Compliance is the real linchpin. Bitcoin by nature is ownerless, pseudonymous, with no off switch. In contrast, XRP is built with control mechanisms, such as asset freezing when necessary, compliant with AML, compliant with KYC. Put plainly, XRP is crypto that behaves like a traditional financial system. And Ripple. They don't play the game of fighting the system. They play the game of entering the system. Millions of dollars a year are spent on lobbying in Washington, not to break the law, but to help write the law alongside them. And this exposes a very cold truth. Financial institutions do not choose the best technology for users. They choose the technology that best fits their control. XRP is a bank-friendly, regulator-friendly, fee, model-friendly version of crypto. As the legal battle between Ripple and the SEC gradually tilts in a favorable direction, as the new administration becomes more open, the stage is set, institutional capital flows in the media changes its tone, XRP is called the trade of the year, and the play is complete. So, with all of that, what is the most practical question for the listener? Should we avoid crypto altogether, because the game is now controlled by the big players? Not exactly. The fact that Wall Street financializes an asset does not mean the core idea behind it is wrong. Bitcoin's original thesis remains intact, a scarce, verifiable asset capped at 21 million units. Meanwhile, central banks around the world will continue to print money, and as long as that happens, demand for assets that cannot be inflated away will continue to exist. This reminds me of the dot-com bubble of the late 1990s. The internet was a real revolution, and it did change the world, but most companies from that era disappeared. Pets.com being a classic example. Who were the winners? Those who truly understood what they were buying, like Amazon, or those who patiently invested long-term through index funds. And crypto is no different. The question is not, will crypto die, but rather, are you holding the control, or are you simply buying the story someone else is telling you? A very accurate comparison. And if there is one single thing that helps you avoid becoming liquidity for someone else's profit-taking, it is understanding the psychological model behind these cycles. I call it the exit liquidity model. Most growth cycles of assets like these repeat through four familiar phases, not always 100% identical, but similar enough that many people fall into the trap. The first phase is quiet accumulation. This is when institutions and large players quietly accumulate assets while prices are still low, no noise, no positive news, no FOMO. Headlines at this point are full of skepticism and ridicule phrases like, "This thing is dead," or "It's only for speculation," and that is exactly when they want to buy. The second phase is narrative shift. Suddenly the tone begins to change. You start seeing headlines like, "Smart money is stepping in," "Large institutions are getting interested," "Crypto is being legitimized." The goal of this phase is to build trust and legitimize the asset in the public's eyes, not yet to make you buy aggressively, but to make you start paying attention, like, maybe this isn't so bad. Then comes the third phase, media acceleration. Prices start rising fast, charts go vertical, FOMO spreads. Experts appear on TV, price targets sound like science fiction. At this point, the question is no longer whether you should buy or not, but if I don't buy now, will I miss out? And finally comes the fourth phase. Also the most dangerous retail investor, FOMO, becomes exit liquidity. This is when people like David can't take it anymore. Prices are up 300 to 400%. Social media is flooded with profit screenshots, and they jump in. That very flow of money creates enough buyers for the institutions that accumulated from the first phase to exit smoothly, without panic, without drama, just a transfer of money. And here is the core question. Everyone needs to ask themselves, if this is such a great opportunity, why do financial institutions need to aggressively advertise it to you after the price has already gone up 400%? The answer, if you dare to look at it directly, is quite clear. They don't need you to get rich with them. They need you to become the one who pays for their profits. So after all this analysis, what practical conclusions can we draw? In my view, there are three major lessons. The first and most important is to clearly understand your own investment thesis. Bitcoin is a bet against the long-term debasement of fiat money. XRP is a bet on the banking system adopting a semi-centralized token. Two completely different stories, two completely different types of risk. Never buy an asset just because its price is going up. Buy because you understand the story and can accept the cost if you are wrong. The second lesson is not to treat crypto as an investment strategy. It is not a foundation, not a financial plan, but should only be a small part of a diversified portfolio. It is an asymmetric bet, small position, large upside potential, but if it fails to zero, you are still fine. If an investment can destroy your life when it goes wrong, then the problem is not the asset, but the size of your position in cryptocurrency. There is a very small detail, but if you overlook it, you overlook the entire essence of the issue. When you buy a Bitcoin ETF, you do not actually own Bitcoin. You do not have the private keys, and you do not control the asset. What you are really holding is merely a promise from BlackRock that they are holding Bitcoin on your behalf, and that runs completely counter to the core philosophy of cryptocurrency from day one, not your keys, not your coins. ETFs bring convenience, but they take away sovereignty. And this is where we need to pause to clearly see something very important. Perhaps the biggest lie was, never crypto is a scam. The biggest lie is that financial institutions do not care about crypto. The truth is, the exact opposite. They have always been paying attention. They just did not act immediately. They bought time to build infrastructure, to obtain licenses to create financial products. And now, when the toll booths are ready, the gates are thrown wide open. The lights are turned on, and they warmly invite all of us to step inside. So the final question for the listener is not will crypto exist or not, because that has almost been answered, but rather who its real power will belong to. Digital assets may continue to grow, prices may rise, products may become increasingly convenient, but financial sovereignty is not something Wall Street bestows. Decentralization is not a gift, it is a right, and each individual must claim and defend it themselves. If there is one most important skill in this era, It is not picking the right coin, but the ability to distinguish between the story being told and the real structure being built. Because only when you can see the structure do you avoid becoming a pawn in someone else's chess game.